Hello guys, how are you? I hope you are doing fine. This is your Professor Brahim Gizani, and today I'm going to present for you chapter number 6, the cost of production. Okay, this chapter, as you know, it is based on the textbook Principles of Macroeconomics by Gregory Mankiw, and the slides are prepared and by Professor Ron Cronovich, and I will be working on these materials. Okay, what is about interesting about this chapter? This chapter is actually it is very easy. Don't worry about that, and it's full of definitions and interesting lessons about costs. So it will not take. It will not be very hard to understand. It's very simple definitions, but it is very important because this chapter is related to the following chapter will be seeing. The following chapter will be will be about firm behavior in different markets, and the first case we will see the firm in a competitive market. So why costs are very important for a firm in a competitive market? Because costs are closely related to the decision making of the firm. When we talk say decisions, we mean principally the level of production. What is the right level of production that the firm should produce, and what is the price the firm should be selling? Okay, so the price, the costs are related to the level of production, and and is a key determinant of its production and firm's pricing decisions. As you know, a firm will make this assumption and that the firm is looking to maximize its profits from its business. Maximizing this profit suggests that the firm needs to determine what is the optimal level of production, how much units should the firm produce to attain the highest profit possible. So you will see that the determination of this important level of production and the decision about the level of production is closely related to the costs of the firm. So therefore, we'll need to study and to understand the behavior of these definitions of these different types of costs, the various type costs, and how are they related to each other and to the output. When we talk about output, we mean production. Okay, and first of all, what does it mean a cost from an economist point of view? Economists have their own definitions of costs. So we'll start by defining how economists see and assess the costs, and then we will see different definitions about different types of and concepts of costs, okay, and their behavior, the behavior of these costs. By the behavior, I mean how they evolve in accordance or in relationship with the level of production. The understanding the behavior of costs will enlighten us about what are the best and the optimal level of production that can make a firm profitable, and not only profitable but at reaching its highest level, highest profit. Okay, and then the last part of this chapter will see that costs behave differently, whether we look in the short run or in the long run. So the difference will not be very significant, but there is some differences. So we'll see. I forgot to tell about this concept of economies of scale. We will see in the following slides. Total revenue, total cost, profit. So the definition, we assume that the firm goal is to maximize profit. Of course, I think this assumption is widely acceptable. A firm is doing for a for-profit organization, unlike non-profit organizations like associations or cooperatives. Firms are doing business, and like any business, a firm is always looking to reach the highest profit possible. Okay, of course, in industrial organization, this assumption is somehow debated and discussed, but this discussion is not the object of our chapter today. So we'll assume that a firm's goal is to maximize its profit. So the profit is total revenue minus total cost. Total revenue is the amount a firm receives from the sale of its output, and the total cost is the market value of the inputs a firm uses in production. So here the costs, as you see, the costs are related to the value of inputs a firm, and the inputs are all materials or resources used by a firm in its production. Okay. How about costs? Costs, explicit versus implicit costs. So why there is two types of costs here, implicit and explicit? This difference is because of how economists differ from accountants in evaluating and assessing costs. Explicit costs require an outlay of money, example, paying wages to workers. So explicit costs are related to cash, to money, to flow of money into or out of the firm. So they are somehow materialized by cash, payment of cash. However, implicit costs do not require a cash outlay. So the costs, the implicit costs, they are not necessarily or do not require a payment of cash, like in the explicit costs. For example, the example we know all and the economists always talk about it is the opportunity costs. The opportunity costs, for example, of the firm's the firm's owner's time, for example. The firm's owner's time is an opportunity cost, and it is not materialized by a payment of cash. So it is an implicit costs. So remember, one of the 10 principles we talked about, the cost of something is what you give up to get something. This is actually the definition of the opportunity cost. It is what you give up to get something. So this is true whether the costs are implicit or explicit. Both matter for firms' decisions. So explicit costs and implicit costs. An example. For example, here you need $100,000 to start your business. The interest rate is 5%, example. So we have two cases, two options. In the case one, you can either borrow this $100,000 and you will pay the loan, the interest on this loan. For example, each year you will have to pay $5,000. This $5,000 is paid to the bank, and it is a cash that you pay. Okay, so it is and it is there is a cash underlying these costs, so it is an explicit cost. Okay, you receive from the bank in your account records something proving an entry, an accounting entry proving that the bank has paid itself $5,000. So there is a proof about this cost that you have to pay. Case 2, you decide a different idea using, for example, $40,000 of your savings and borrow $60,000 from the bank. Here, instead of borrowing $100,000, you borrow $60,000. So the explicit cost is, of course, the interest you pay on the loan. So it is 5% times $60,000. So you will have to pay $3,000 to the bank as an interest every year. Okay, this is an explicit, and this is an explicit cost because there is a proof, there is a cash paid, and there is a bank account transcript that shows this payment. But in the case 2, there is an implicit cost. What is this implicit cost? It is what we gave up here. Here, by using 40,000 of our savings, we gave up an interest we could have earned from these $40,000 of saving. So there is, if the interest on saving is 5%, 5% times $40,000, it should give $2,000. So by employing this $40,000 and by withdrawing $40,000 from our savings to start our business, we gave up the return we could have we could have from this $40,000. This return or this interest is $2,000. It is 5% times $40,000. So here we assume that the interest you pay to the bank is equal to the interest you receive from your saving. Okay, so please don't confuse yourself. Here it is an example that took both interest rates as equal, but in the real world, they are not, of course, they are not always equal to each other. So here, so to come back to our example, here there is an explicit cost based on cash we pay to the bank that is equal to $3,000, and there is another type of cost that is an implicit cost representing the return foregone from using the savings or a certain amount of our saving in a business, which is $2,000. this makes, in both cases, total costs are equal to $5,000. Okay. Why we there is consider implicit costs? Actually, it is this distinction is related because economists, as I said, assess costs differently than accountants. For example, accounting profit, total revenue, it should be equal to total revenue minus total explicit costs. An accountant, when computing the profit of the firm, of course, he bases his calculation on bills and on tangible proofs that explain, that show how money flows into and out of the firm, and he or she calculates these costs. But economists have a different view to these things. Economists do not only consider explicit costs, but also they include implicit costs in their calculation of firm's profit. So the firm's profit, according to economists, is total revenue minus total costs, including explicit and implicit costs. So economists include the costs that are underlying cash payment of money, and also they include the costs that do not have that are not proved or based on cash, and such as the implicit costs. So accounting profit ignores implicit costs, so it's higher. So it should be then higher than economic costs, economic profit. Sorry. Okay, so economists here include in their calculation of firm's economic profit the implicit costs such as the opportunity costs. The opportunity cost, usually there is no proof, there is no paper that shows that this cost is has resulted on payment of cash and money. So here is the difference between the two different points of view on firm's profit. Production function. So here we are going to see the production function. I remember we have seen this an example about this production function in chapter 1. We talked about it. We said that production function actually shows the relationship between the quantity of inputs and the quantity of outputs of a firm. So the relationship between the quantity of outputs used to produce a good and the quantity of output of that good. So it can be represented by a table, equation, or a graph. In chapter 1 we have seen a graph showing this production function. Example here, for example, farmer Jack grows wheat. He has 5 acres of land and he can hire as many workers as he wants. Okay, so let's try to draw the production function of Jack. Here we have L, number of workers, representing the number of workers. It is the input here used here is the number of workers, the labor, and Q representing bushels of wheat, representing our output. Okay, so let's see. According to the number of workers, the quantity of inputs, what Jack can produce. If he uses, of example, 0 workers, he gets nothing, of course. 1 worker, he gets 1,000 bushels of wheat. 2 workers, obviously the quantity produced increases. So here you see these green dots representing the graph of the production function on the plane. Here quantity of outputs, and here we have number of workers. Okay, we complete our table, and in the same time we trace our production function. You see, production function is a rising curve. It's obvious. As we add more workers, as the quantity of output increases. Okay, but observe something here, something important. The first worker, the worker number 1, could bring or could produce 1,000 bushels of wheat. Okay, but the worker number 5 could produce only this small quantity of wheat, which is, from the graph, as you can see, it is lower than the production of the worker number 1, if we compare these two. So here we see that, can observe that the productivity of workers decrease as the number of workers increase. This is why at the beginning the slope of the curve is high, but the curve then flattens. It flattens. As the number of workers increases, the production function curve is flattening. We will see in the coming slides why this is happening. So to understand that, we defined something, an important concept here. It's called the marginal product. The marginal, if Jack hires 1 more worker, his output rises by the marginal product of labor. The marginal product of labor. What is the marginal product? Is the marginal product of any input. The marginal product of any input is the increase in output arising from an additional unit of that input, holding all other inputs constant. So if we notate delta as represent a change in a variable, so and therefore delta Q represents the change in output, and delta L represents the change in labor. So the marginal product of labor, MPL, would be delta Q over delta L. Delta Q over delta L, the change in quantity of output over the change in input, which is here in our case labor, tell us about the increase in output arising from an additional unit of that input. So let's compute the marginal product of labor for Jack. Here we put again the data about labor and the corresponding quantity of output to each number of workers. So you can compute the marginal product of labor by dividing delta Q over delta L. Here, the first worker produces 1,000 units or bushels of wheat. Delta Q is then 1,000, and the number of workers at the beginning is the change in work is 1. So 1,000 over 1 gives us an MPL of 1,000. If the worker number 2, produces 800 bushels of wheat. So the MPL becomes 800. Observe, notate that as we increase the number of workers, the marginal product of labor is decreasing. So let's see for the worker number 3. The worker number 3, he produces 600 bushels of wheat. So this makes an MPL of 600. The same thing, worker number 4 and worker number 5. So you see the worker number 5, his product, he could produce only 200 bushels of wheat. You see here the worker number 5 has a productivity lower than the productivity of the worker number 1. So MPL is actually the marginal product of labor somehow is representing the productivity of each additional worker. And in general, the marginal product is representing the productivity of each additional unit of inputs. You see, the marginal product is decreasing as we increase the number of workers. This is why the production curve at first it rises strongly. Then as we increase the number of workers, it's getting more and more flat. The marginal product of labor equals actually the slope of the production function. Notice that MPL diminishes as L increases. This explains why the production function gets flatter as L increases. As I said, so the MPL is the slope of the production function. You see here, delta Q over delta L is actually the slope of this curve. See, the slope is at first it is 1,000, then it is 800, then with the third worker it becomes 600, the fourth worker it is 400, and then the fifth worker it is 200. So the MPL representing here, it is the marginal product represents the slope of the production function. Why MPL is important? Recall one of the 10 principles: rational people think at the margin. You remember this principle: rational people think at the margin. What does that mean in this case? When Jack hires an extra worker, what's the thought that are in his mind when he thinks about hiring an extra worker? Here he is a rational individual. So I will show you here how this rational individual is thinking at the margin. He compares two things: the costs of hiring one extra worker and the cost of hiring one extra worker is the wage he pays to that worker. So he compares these costs to the revenue that is going to come from this extra worker. The revenue is represented by the output and how much output this extra worker is going to bring or to produce. This extra worker production is represented by his marginal product of labor. How much units of output this extra worker will produce. What is the participation of this extra worker in rising total output? So he compares these two things, the costs and the revenue of this extra worker. Comparing them helps Jack decide whether he would benefit from hiring the worker. So then he after comparing these two things, he will decide whether it is beneficial and profitable for him to hire this one more worker or not. So this is what does it mean rational people think at the margin. At the margin here is the one extra input. The one extra input. What are the costs of this one extra input, and what is the output from this extra input? Why MPL diminishes? So why the MPL is not constant, for example? Why the production function is not the slope of the production function is not constant? Why the level of the productivity of the worker number one is not the same as the productivity or the marginal product of the worker number 100? Why the worker number 100 produce less than the worker number 99, and the worker 99 produce less than the worker number 98? So there are reasons for this, of course. Jack's output rises by a smaller and smaller amount for each additional worker. So why? As Jack adds worker, the average worker has less land to work with and will be less productive. So in this case, in this farming example, the additional worker will have less land to work in. So because he has less land to work in compared to the worker number one or the worker number two, obviously his productivity will be lower. In general, MPL diminishes as L rises, whether the fixed input is land or capital, equipment, machines, etc. So there is a principle called diminishing marginal product. The marginal product of an input declines as the quantity of the input increases, other things equal. So other things equal means nothing changes except the input we are talking about. So if other things equal, as the marginal product of any input, whether it is labor or capital or whatever, as we increase the number or the quantity of this input, always the production function, the production curve is going to flatten, and meaning that the marginal product of that input is decreasing as the quantity of that input, whether let it be land, equipment, worker, whatever, as the quantity of the input increases. So it is like a law here. So here, example 1, farmer Jack's costs. Farmer Jack must pay $1,000 per month for the land. So it is the rent of the land, $1,000, regardless of how much wheat he grows. The market wage for a farm worker is $2,000 per month. So farmer Jack's costs are related to how much wheat he produces. So let's compute the costs of Mr. Jack. The cost of the land is fixed here. It does not vary according to the output, whether the output is 0 or 3,000. The cost is always 1,000, as you see. The cost of labor. The cost of labor, how do you think it will vary? Of course it varies. As the number of workers increases, the cost of labor is going to increase because we have to pay more and more wages. So here the cost of labor increases as, unlike the cost of the land, the cost of labor varies according to the level of output. Okay, so here we have the cost of land that does not change according to the change in the output. It is always $1,000, but the cost of labor, it changes according to the change in the level of output. Well, if the farmer produces 1,000 bushels of wheat, the cost is $2,000. But if he wants to produce 2,800 bushels of wheat, the cost of labor becomes 8,000. So it does not change. It does change with respect to the quantity of output. So here we have a cost of land that do not change with the quantity of output. We call this cost fixed cost. And we have here a cost of labor that changes with the quantity of production. We call this cost a variable cost. And here we have total cost. Total cost, of course, it is the sum of all costs here. Cost of land and cost of labor. So if we try to draw the total cost curve, here we put in this, we draw in this plan of total costs and quantity of output with the curve of total cost. It has this shape. Here in the slides we are going to define an important concept in